Alternative investments have been attracting more and more investment dollars over a number of years. Some pension funds, in fact, have 50% of their assets or your assets in private investments. For more on the alternative investment space, we're joined by Jay Bala. He's a senior portfolio manager at AIP Asset Management. Jay, nice to see you.
Oh, thank you.
Thanks for coming in.
Absolutely.
I want to first get from your perspective how, for a private client, you are able to access or how you go about accessing some of these private investments or alternative investments. What does it look like to you?
For our private clients, what we look at really is we just look at fund managers. What we don't want them is piecemealed into deals where they have no real power. So, part of being in a private investment, whether it be equity or debt, is your ability to vote.
Okay.
Right? So even if you're in a private loan or a private credit, your amount of that loan, like let's say you hold 90% of the loan, then you get 90% of the votes. What you don't want to do is piecemeal it to 10,000 people, and then if something goes wrong, even if something minor goes wrong, you need to go and collect votes from 5,000 people to move things along. So you want to pass it on to a money manager that actually knows what they're doing, how to vote, how to take care of a default as required, or how to make changes. And a lot of them just really are minor changes. It's not massive changes.
Okay.
And so you don't want to have a vote every time somebody misses something that's relatively minor.
Right. Let's step back, though, maybe describe for some of our viewers really what the alternative asset space looks like today. What kind of investments are we talking about?
Sure. So, that has become a very broad space, and it now encompasses a lot of things. So it includes direct real estate as opposed to a REIT. It involves direct loans to companies instead of buying just a bank or a credit company. It involves direct ownership of either private or even public companies in some matter, but it's far more direct. It's far more controlled, and it's a very broad spectrum. So people need to understand this asset class. And we said, sort of our New Year's resolution we're telling our clients should be, look slightly outside the box. Like, we're not telling you to just go out there and start trading random currencies. We're telling you just kind of look a little bit outside your comfort zone and start getting educated on these things.
Okay.
It isn't a random accident that CPPs got half their assets in non-traditional assets, right? It's because you've had a blowout equity market for the last 10 years. That's going to end one day, right? Like, I'm not saying it's going to end tomorrow, next month, or next year. We're actually quite cautiously optimistic that, this could be a good year for equities. But at the end of the day, that's going to come, right? And you need to be prepared. And you need to start looking at pension funds because that's all they do, right? Like, it's not like they're a part-time doctor and a dentist, and then they kind of are a part-time PM. What they have is thousands and thousands of people that explore the world and look at, okay, what are we going to do, right?
Yeah, and so what are you seeing is interesting in the alternative asset space right now, particularly given the fact that, CPP has been very well recognized around the world as being, at the forefront of moving into private equity.
Sure.
They've been doing it for a long time. Some of the U.S. pension funds have really been lagging, but the reality is so many people now think that this is the way to invest,
right? And
the prices have gotten bid up, and interest rates are so low. There's an inverse correlation. So in other words, the prices that you have to pay to get into private equity today, in some areas, just don't make any sense.
Yeah. So you're absolutely right in both private debt and in private equity. Private debt's a bit more, is a newer category. But you're absolutely right when it comes to the very large transactions. Because if you look at a CPP that manages $400 billion, you're going to write $1 billion check. And then you're going to have to do it as part of a club or a team because you don't want to take too much exposure. So now you're looking at like a $5–10 billion transaction. How many companies are there in the world where you can write that kind of check and be realistic that that's a good value? So what you have is 90% of the money going after a very tiny sliver of companies. So what you want to do is just go downwards. Just look at sort of these funds that are a lot smaller, these funds that can write $5, $10, $15, $20 million tickets, right? Instead of billions, you're doing millions. There's hundreds of thousands of companies that these guys can go after, but they're only, call it 3–4% of the capital pool out there. So at the lower end of the spectrum, things are still relatively cheap.
Okay.
Right?
Potentially more risk, though.
Well, I mean, not
No?
necessarily. I mean, like
What
lower end of the,
industries? Talk to us a little bit more about some of the granularity here. What you're doing.
Sure. Just so we touch on risk just a bit, right?
Okay.
So you could buy a technology company that does $1 billion in revenue, and you can buy it for 15 times. $1 billion EBITDA, you buy it for 15 times EBITDA, right?
Okay.
You can also get a company that does consistently $10 million in EBITDA and buy it for the same 14 times EBITDA or 10 times EBITDA. It doesn't make it any more risky. It's just a size difference. You know what I mean?
Mm-hmm. Okay.
We're not talking about investing in a company with no EBITDA, right? You know what I mean?
Right.
You know what I mean? It's the same exact metric. It's just smaller,
Okay.
right?
So give us an example of something that's been of interest to you.
Right now, I guess, we're just repositioning all our clients to say, okay, look, rebalance. You've had a great run in your equities, cut back, and let's sort of start looking at different asset classes that you can go into. And like I said, I think 2020 is a very exciting year, so we're just sort of getting geared up to figure out, okay, well, which way is the momentum moving in a lot of these things? Mm-hmm. And all of our investments are, for the hedge fund anyways, are usually structured to figure out, okay, like, look, once we figure out the trajectory of what industry is going to take off, mm-hmm. then you can sort of re-gear these companies towards those industries, right?
So, but your firm, you will do direct investment in these companies.
Correct.
So what's an industry that's been interesting?
That's been interesting.
To actually put money, putting money to work. That's what I mean by interesting. Where do you think you're making money? Which industry? And it's in Canada. I think you mostly focus on Canadian companies.
Canada and U.S. Okay. For 2020, I guess it's still early days, but look, we're thinking probably technology. We're still like healthcare just because the population is getting older. The longer term trends are definitely there. And possibly resources, but we don't know yet. You know what I mean? Like resources, we're sort of on the fence on a bit because it looks like phase one is done with the U.S.-China trade deal. Let's figure out how this election is going to come along, how that growth curve in the economy is going to come along. But resources could be a really good play this year, right?
Jay, did you pay much attention to the Bank of Canada today and the fact that they cut the growth outlook and they seem a little bit more concerned about the Canadian economy? Where does that play into the companies and industries that you would invest in here in Canada?
Yeah, to be honest, I think it was relatively expected. I don't think there was a massive surprise. And again, the reduction in growth was, it was in like 10 basis points or something they dropped it by. It's not the end of the world, right? It is what it is. I think at the end of the day, you might come into Q3 and realize, okay, yeah, we're just going to restate growth upwards, cut by a couple of basis points. That's not a huge thing for me.
Okay, so you're not too concerned about the Canadian economy, in other words?
No. I think it's just all steady by now, right? The U.S. seems to be holding in there.
Seems like it, but that's not what we heard today. So we'll see. We'll see. I don't know why such a dramatic change, but everybody has a different opinion. Jay, nice to see you. Thank you.
You too. Pleasure.